You can invest in companies from around the world without ever leaving your home market. But here's the catch. You might not actually own what you think you own. Let's break down ADRs and the hidden trade-offs investors miss. Question 7. A key benefit for an emerging market company that chooses to list its shares on an exchange in a developed country is that it A. Eliminates its exposure to fluctuations in its domestic currency. B. Can gain access to a deeper and more liquid pool of investor capital. C. Is no longer subject to the financial reporting standards of its home country. Correct answer, B. Companies in emerging markets often struggle with limited funds and not enough money flowing through their local stock markets. But when they list on a well-established exchange, they open up a whole new world of institutional and retail investors, which makes it easier to get the capital they need. These developed markets have bigger and more liquid capital pools, which means more trading, more stable prices, smaller bid-ask spreads, and more people investing. All of this leads to lower costs and better handling of big share offerings. Plus, being listed internationally can really boost a company's reputation and make it more noticeable, which can draw in capital from global funds, like index tracking ETFs, if the stock qualifies. A. Incorrect. Listing abroad does not eliminate foreign exchange exposure, as a company's underlying operations and earnings remain denominated in its domestic currency. Currency risk can be partially transferred to investors, but the issuing company is still affected by exchange rate fluctuations. C. Incorrect. Listing in a developed market increases reporting burdens due to compliance with both home country and stricter foreign exchange regulations. This results in improved transparency and investor confidence, not regulatory exemption. Question 6. A European investor purchases unsponsored American depository receipts, ADRs, of a Brazilian mining company. The company announces a shareholder vote on a major asset sale. Who is entitled to cast votes on behalf of the underlying shares represented by those ADRs? A. The Brazilian mining company's board of directors, B. The depository bank that issued the ADRs. C. The European investor as the beneficial owner of the ADRs. Correct answer, B. In unsponsored depository receipts, the depository bank keeps the say on the shares they're holding. The depository bank buys the foreign shares on its own, puts them in a trust, and then gives out the receipts without asking or getting permission from the company that owns the shares. Since the company doesn't help out, the depository bank gets the legal ownership of the shares and can use all the voting rights that come with them. So, investors in unsponsored DRs are considered beneficial owners, but they don't get to vote. In unsponsored ADRs, the depository bank doesn't have to ask or follow voting instructions from ADR holders. Even though a depository bank might decide to gather and use investor feedback, they're not required to do so. The rules make it clear that the depository bank gets to decide how to vote in unsponsored ADRs. A. Incorrect. The board of directors, elected by shareholders, does not vote shares on their behalf, including those in DOCT programs. C. Incorrect. Unsponsored ADR programs do not confer voting rights to investors, unlike sponsored programs where voting rights are typically passed through. Question 5. A multinational technology firm headquartered in South Korea is evaluating ADR structures to access U.S. investor capital. Which of the following statements is least accurate regarding a Level I unsponsored ADR program? It can be used to raise new equity capital through a public offering in the U.S. B. It trades over the counter and does not require full SEC registration. C. It imposes no earnings or size requirements on the issuing company. Correct answer, A. Level 1 unsponsored ADRs are made from shares that are already trading in the home market, so no new shares are created or offered publicly in the U.S. To get new money, you need a Level 3 sponsored ADR with Form F-1 registration and SEC approval. Just so you know, you can't raise money on U.S. markets for Level 1 unlisted ADRs, whether they're unsponsored or sponsored. Only Level 3 ADRs can do that. Just so you know, the foreign issuer isn't part of the picture, so we can't use the ADR program to put together a capital raising event. That kind of event needs the issuer to team up, get underwritten, and get the SEC's approval. When we talk about sponsored versus unsponsored, we're really looking at how much the issuer is involved. Level 1, 2, and 3 are all about where the company lists its shares and what the SEC needs to file. To raise money, you can only do it in Level 3, and you need to have it sponsored. So, the South Korean tech company's goal of getting U.S. investor money just isn't going to work with a Level 1 unsponsored ADR. Be incorrect. Level 1 ADRs trade OTC and require less SEC filing than major exchanges. See incorrect. Level 1 programs lack minimum market capitalization, earnings, or liquidity requirements. Question 4. A key advantage of using an exchange-traded fund, ETF, that holds a basket of depository receipts, compared to building a portfolio of individual American depository receipts, ADRs, is the ETF's ability to provide a direct voting rights in each of the underlying foreign companies. B. Exposure to a specific single foreign market leader. C. Instant diversification and lower trading costs for the investor. Correct answer, C. An ETF, like the BLDR, is a single security you can buy and sell on the stock market that holds a collection of depository receipts, such as the Invesco BL DRS Asia 50 ADR Index Fund, which tracks 50 ADRs. When you buy one ETF share, you get instant access to all the securities it holds, which means you're already diversified in one go. This way, you don't have to make lots of separate trades, which saves you money on brokerage fees, especially if you're not paying a commission or if you're dealing with international transactions. And it also makes keeping an eye on your portfolio easier. A BLDR is a special type of ETF that holds a collection of DRs and aims to mirror the price movements of a specific doctor index. Its main goal is to provide broad, non-specific exposure. ETFs are often seen as a flexible and budget-friendly way to get a taste of international investments, while individual ADRs are better for focused, active approaches. For those who don't have a lot of money or know much about investing, using a BLDR ETF can make it easier to get into global stocks. A. Incorrect. ETF investors in sponsored ADRs own fund shares, not the underlying ADRs, and lack direct voting rights. In unsponsored ADRs, the depository bank retains all voting rights. B. Incorrect. ETFs are index-based and diversified, unlike ADRs, which target single foreign market leaders. Question 3. A U.S.-based investor is comparing sponsored and unsponsored American depository receipts, ADRs, for the same foreign company. Which of the following is a key advantage of choosing the sponsored ADR? A. The depository bank retains all voting rights, simplifying corporate governance for the investor. B. The investor is exempt from U.S. capital gains tax on the investment. C. The foreign company is directly involved, which typically provides the investor with voting rights and ensures greater regulatory disclosure. Correct answer, C. It points out the two big benefits of a foreign company joining a sponsored ADR program. Voting rights. In a sponsored ADR, the company and the depository bank make a deal that lets the ADR investors take over the voting rights. This means they can have a say in what the company does, just like any other shareholder. Greater regulatory disclosure. Sponsored ADRs, especially those on major exchanges like Level 2 and 3, need the foreign company to register with the SEC and keep up with their reporting, like filing annual reports on Form 20F. This gives U.S. investors more visibility and information, which is not always the case with unsponsored ADRs. A. Incorrect. Unsponsored ADR structure retains voting rights with the depository bank, disadvantaging investors seeking full ownership rights. B. Incorrect. ADRs are treated as domestic securities for U.S. tax purposes, and investors are subject to U.S. capital gains tax on profits from their sale. Question 2. A U.S. investor purchases unsponsored American depository receipts, ADRs of a German automotive company. When the company holds its annual general meeting, who is legally entitled to cast votes for the underlying shares held in the ADR trust? A. The investor as the beneficial owner of the ADRs. B. The German company's board of directors. C. The depository bank that created and administers the ADR program. Correct answer, C. In an ADR that's not sponsored by anyone, the bank takes care of buying the shares in the foreign exchange and putting them into a trust. Since the bank is the official owner of the shares, it keeps all the rights that come with owning them, like the right to vote. ADR holders are just the ones who get to benefit from the shares. They don't actually own them, so they can't vote. The foreign company isn't officially connected to the depository bank for this program, so the voting rights don't get passed on to the investors. This absence of investor voting rights is what makes unsponsored ADRs unique, setting them apart from sponsored ADRs, which offer more transparency, voting rights, and regulatory information. When choosing an ADR structure, you're balancing how much information you share, who controls things, and how easily you can get into the market. Sponsored ADRs give you voting rights because the company from abroad is officially involved. They need to be more open about what's going on and follow more rules, but they also give you stronger rights, like voting. Unsponsored ADRs don't give you voting rights because the bank that holds the money doesn't have to ask you what you want to vote on. They're easier to use and let you get into companies from other countries, but you might have fewer rights and less information. A. Incorrect. Beneficial ownership provides economic returns, while voting rights are tied to legal ownership held by the depository bank in unsponsored ADRs. B. Incorrect. The board proposes matters for shareholder vote, but does not vote shares on their behalf. Question 1. The total return of a U.S. investor's American depository receipt, ADR, is least likely to be directly impacted by a change in a market price of the underlying foreign common shares on their home exchange. B. Depository bank's fee structure for administering the ADR program. C. Exchange rate between the U.S. dollar and the currency of the underlying shares. Correct answer, B. The total return on an ADR is made up of a few things. How much the price of the foreign shares changes. The dividends you get from the foreign company. The ups and downs in the value of the foreign currency when you switch it to USD. ADRs are priced so that they automatically reflect the foreign share price, taking into account the exchange rate. Things like how the company keeps your money or the fees they charge can lower the dividends you actually get, but they don't really affect the market prices or the value of the foreign currency. Depository bank fees are just a small administrative expense, and they don't really affect the main parts of an ADR's return. These fees might lower your income a bit, but they don't set the price of the ADR or how much currency you'll get. So they're probably not the biggest factor in how much you'll end up with overall, compared to things like how the market is doing and how the currency is changing, which are the real drivers of return. In the end, your total return comes down to how the market is doing and what's happening with the currency, not the fees. A. Incorrect. ADR prices and returns mirror the performance of the underlying shares. C. Incorrect. ADRs expose U.S. investors to foreign exchange risk, impacting total return.